But the real question is how this system managed to expand so rapidly in the first place. What sets shadow banking apart isn't just its scale, but its structural vulnerabilities. When you deposit money in a bank, it's insured and the bank can access central bank liquidity in a crisis. Shadow banks don't have these protections. Instead, they gather funds through investments, not deposits, and lend or trade with them without access to deposit insurance or direct central bank support. Collective investment vehicles, such as hedge funds and other investment funds, are not covered by deposit insurance, and their assets are typically ineligible as collateral for Federal Reserve liquidity, as outlined by the 2A7 rules. This leaves them exposed to sudden liquidity shocks. A clear example came in September 2019 when the overnight repo market, a critical source of short-term funding for both banks and shadow banks, saw borrowing costs spike above 10% in a single day. The Federal Reserve responded by injecting more than $75 billion per day into the system through repo operations. The vulnerabilities didn't stop there. In March 2020, as the pandemic hit, non-government money market funds faced over $120 billion in outflows within a week, forcing the Fed to step in with emergency lending facilities to prevent a broader collapse. Private equity and hedge funds introduce further instability. They often lock up investor capital for years and make highly leveraged bets on markets ranging from corporate debt to real estate. When too many investors demand their money back at once, liquidity can disappear rapidly. This dynamic played out during the UK pension crisis in 2022, when leveraged bond strategies nearly triggered a cascade of failures in retirement funds. Traditional banks and shadow banks are now deeply interconnected. Banks rely on shadow banks for securities lending and short-term funding, while shadow banks depend on banks for access to payment systems and liquidity. When a major player falters, the disruption can spread quickly across both sectors, as seen when Archegos Capital's hidden leverage unraveled, leaving global banks with billions in losses. The influence of shadow banking now extends to pensions, mortgages, and corporate lending, growing in part because these entities operate outside the regulatory perimeter. Their ability to sidestep capital requirements and stress tests has fueled explosive growth, all while remaining largely hidden from public scrutiny. But the real question is how this system managed to expand so rapidly in the first place.